So I want to thank very much Jean-Pascal Van Ipersel for coming, because this first panel is about carbon pricing. I think it was very important to explain that we vitally need a total transformation of our economic systems. It's not just energy, it's not just renewables. We need to change completely everything, because a zero net economy is not the kind of economy that we have now with fossil fuels. We need different cities, we need a different agriculture, we need different industrial processes, we need different buildings, we need a different mobility, and so on and so on. And personally, I'm convinced that it's not only a need, it's also a huge opportunity. And I think this was very well transmitted also by Jean-Pascal. So I think it's a reconstruction project for our economies. It's a reconstruction project for our societies. It has also huge redistribution opportunities, which we'll discuss after the break. And so the question is how we do it. And several economists have discussed the possibility that regulation would enforce a tipping point of carbon pricing. Carbon pricing is not only a tax, it can be an industrial norm, it can be a change of subsidies, it can be a market. It doesn't matter what it is exactly. What's important is that in the economy, emitting carbon dioxide costs a lot of money, and so much costs that it's dissuasive and it triggers other projects. So it kicks the green economy off the ground. So our panelists will introduce themselves, and I will ask very briefly to each of them to say what they know, what they believe on the opportunities of a regulatory sufficient level carbon pricing to trigger the transition. So I'll introduce them very briefly, and then they will present themselves in more detail. We have Luca Taschini, who is working at the London School of Economics Grantham Institutes, which is one of the best European universities on carbon issues. We have Pierre-Emmanuel Noel, who is a representative of the EIB in Belgium, and who can testify as a banker what is bankable or not with which carbon pricing. We have Peter Sweatman of Climate Strategy, who is advising corporates on their decarbonization strategy, and Anthony Hobley of Carbon Tracker, great specialist of decarbonization. So actually, I'm sorry, I did introduce you. If you don't mind, because we are running short of time, Luca, do you want to start and tell us what do you think as an economist? First of all, do you agree with what I said? Do you think that carbon pricing would have the power to trigger the transition? And if so, can you tell us a little bit how the economists are seeing this issue?
Okay, thanks a lot. Thank you very much for the kind introduction. So I've got the challenging task to summarize the Stern-Stiglitz carbon pricing report. And I have to do that in 3 minutes. So, and answer also your question and relate that to sustainable finance. So let me see if I can achieve that. So first, we do have, we need market-based instruments. That's the only way you can internalize this type of costs that are not yet internalized. We can do that via, as you just suggested, explicit pricing. That will be taking the form of carbon price, predominantly carbon taxes or emission trading system, cap and trade, or implicit type of pricing. So think in terms of emission standards or technology standards. So what I think is important to keep in mind is that as of now, we have a patchwork of different systems in place. I think approximately 40 different schemes around the world. A combination of taxes, carbon taxes, and a combination of emission trading systems. When we deal with carbon taxes, price is fixed, but we do not necessarily hit a certain target in terms of emissions. Conversely, when we have an ETS, we have a certainty about the overall cap under regulation, but the price is not fixed. So the fact that the price is not fixed implies that we do not know, as of now, what will be these strong price signal that you just mentioned. I think there are particular elements that need to be emphasized, and that are properly emphasized in the Stiglitz-Stern report. I would not talking too much about mechanism design. I can get very much excited about that and lose a lot of time. But I think the predominant aspect that need to be taken into account is the fact that you need to design these policies in a dynamic way. So you need to build in responsiveness. And that's related to your point of strong price signals. So in a world of uncertainty, especially when you fix the quantity but you don't fix the price is just purely reflecting supply and demand and the expectations of regulated entities about current and future states. So that's what we are suggesting as economists. We did observe that currently here in Europe, the market stability reserve in a way is a form of responsiveness in the system. Other schemes are already implementing similar type of responsive mechanisms in California, in South Korea. So that's absolutely something that we welcome. Now, there are two other very important aspects related to the efficiency of carbon pricings, and are related to the credibility and the predictability of the pricing signal. Credibility and predictability, I think, are extremely important when it comes to talk about sustainable finance. So there is another initiative that we are currently undertaking at the LSE. We are trying to, we believe that financial markets will play and are playing a key role in mitigating the risks associated and exacerbated by the climate change. And we're trying to understand to what extent these particular type of climate change related risks are priced in capital markets. And obviously, if you do not have a credible and predictable price, those will not be reflected into capital markets. It's also fair to say that there are particular aspects that are not salient enough as of now in capital markets, and that's exactly what we are currently investigating. But again, going back to pricing, I think that, in particular carbon pricing, I think that the main aspect that we need to remind ourselves is that we would like to have a consistent, ideally uniform carbon price that is credible and politically palatable.
Yeah.
Thanks.
Thank you. May I just ask you to remind for the audience the level of pricing, global indication that the Stern-Stiglitz report is recommending, and when?
Sure. So the report is basically suggesting a 40-80 US dollar ton by 2020 and an increase of $20 more by 2030. So significantly higher prices compared to today's price. As I said, again, this is very much connected to the current price we observe. They're not necessarily a reflection of the fact that the market is in oversupply with the permits, but is also a reflection of not necessarily oversupply, but also a reflection of scarce credibility of the entire policy.
Okay.
Thanks a lot. Thank you.
This is working?
I hope it is. Can you hear me? Yes. Well, let me first tell you a word about European Investment Bank, where I work, and our role in climate finance. EIB, European Investment Bank, is the bank of the EU. We are a not-for-profit bank. We are AAA rated, and as it turns out, we are the largest such international financing institution in the world. 85 billion of total financing last year. This is 2 or 3 times bigger than the World Bank. So we are a large, not-for-profit public sector bank, financing about 150 countries in the world, different type of projects, around 450 projects. And climate is very important among our activities. You all have heard about green bonds or climate bonds. We invented them. We were the very first financial institution in the world to issue a climate bond, and that was very revolutionary at the time. It was the first time that you were linking a financial product with an underlying pool of assets. And currently, we have a policy to finance at least 25% of our total volume for green projects, whether it's renewable energy, energy efficiency, or research and development in the field of green technologies. At least 25%, that is a hard target for the bank. So climate finance is very familiar to us, and we've been there from the very beginning of it. But what's in a name? It's all fine to say we're going to save the planet and finance will play its role. So green bonds have been the first step. But green bonds, when you look at it, most of the green bonds have been issued by either IFIs or utilities. And they were a first step because asset managers started to require this type of investment. So indeed, you had a sort of virtuous circle, asset managers chasing green investments, and therefore issuers realizing that there was an opportunity to maybe lower a bit their cost of finance. So you have to have a carrot. I mean, finance, someone said before, finance has to be aligned with these ambitions of making the world a better place and reducing greenhouse gas. But if you don't have the incentive, it won't happen. So the first phase was really this incentive, asset managers trying to find this kind of green investment in the form of green bonds. But that's only the first step. Then you had renewable energies financed in a traditional way, in a sort of through a special purpose vehicle, etc. How do these investments take place? What was the incentive? Well, the very first technique that was used was feed-in tariffs, feed-in premiums, and other schemes whereby these investments could be supported by above market prices. And that was not a carbon pricing. Carbon pricing had little to do with it. It was the idea that these technologies needed to be supported through guaranteed above market prices. And when you have a legal framework that ensures that, of course, then this is the carrot. You have private money getting invested in this project. And it has been a success. The technology has evolved. Now the cost of PV has dramatically dropped. Onshore wind is also much cheaper. And it's become, in the banking language, commoditized. There is not an issue of finding finance anymore for this project, as long as you have a robust legal framework. Now, is it the perfect world? Well, you could also wonder, when you have this kind of very generous incentive schemes, sometimes you end up backing the wrong project. That's what happened, for instance, in the biogas sector in Germany. You had overly generous feed-in tariffs, and what happened? Some financial investors started growing crop just to put them in huge digester with a very high 200 euro per megawatt hour or something like that. You had pure, this was maybe not the best use of capital, but this kind of legal framework just resulted in some capital being wasted on the wrong project. You also had, for instance, in Spain, some back and forth in terms of regulation. The tariffs have been retroactively changed. So if you want to bring in finance to renewable projects, that's fine. You have to ensure that you provide a stable and predictable legal environment. If you don't do that, you will have the pendulum might swing in the other direction, and indeed some countries have achieved this sort of own goal of becoming a no-go area for renewable investors. So it's a very, very tricky and subtle equilibrium. If the carrot is too big, you create super profits and the wrong incentives. And conversely, if you don't have an incentive, a financial incentive, it will be hard to attract finance. So, and indeed, the carbon price is something that clearly at the moment is only marginally influencing investments in the EU. And it's even said that it's created the reverse effect. For instance, a country like Germany, which is, as you know, phasing out of nuclear, has decided that its energy mix will be renewables and coal. So when you scratch beyond the surface, you realize that you have created a framework whereby, because of the lack of proper carbon pricing, the gas, which is the sort of least offender in terms of energy, waiting for renewables to become storable, etc., the gas has been completely squeezed by a much worse polluter. So this is the kind of very perverse incentive. Would you have the proper carbon pricing, you would avoid this kind of unfortunate pecking order in terms of the energy mix. So to conclude, because you could really develop a lot of these points, the ETS, I fully agree with what you said before. ETS is not sending a signal that is meaningful in terms of bringing investment to a sustainable project. I wish the ETS was working like Bitcoins. If it was following the same curve as Bitcoins, you would have a very swift transition. But it's not happening that way, quite the opposite. And also, you are focusing on carbon pricing. It is a very important aspect. There are other elements that the public sector has in control to modify, to channel more financial flows. Mr. Gersten mentioned briefly a very important piece of EU law, so to speak. This is the energy efficiency note from Eurostat, and it might seem a bit nitty-gritty, but until recently, believe it or not, the energy performance contract by public authorities, so involving a private financing of investments, the debt linked to these investments was to be recorded on the balance sheet of the public sector. So in countries like Belgium, we had a lot of nice projects that would have a good payback period, that would be really desirable. And yet they couldn't go ahead. Why? Because the public authorities, the municipalities, etc., they didn't have the capacity to record the extra investment on their books. So the EU, and more generally the public sector, has to sort out its priorities and be consistent. Otherwise, you are sending schizophrenic signals. You have to ensure transition, but you have to manage your accounts, and you have to be conservative in recording the debt. So this has changed maybe with this note of September this year, but this is just an example of the kind of inconsistencies that can be extremely frustrating and indeed inhibiting projects in an area, as we have seen from the previous slides. Energy efficiency is even more important than renewables in contributing to reducing carbon emissions. So we have to be consistent, and my word of conclusion would be finance can't replace politics and proper carbon policy.
Thank you very much, Pierre-Emmanuel, because I think that you showed very convincingly the many opportunities for triggering the transition that could come from clearer policy directions from our regulatory governments and authorities. So what do you see on the corporate front, Peter? Can you tell us a bit of your experience with those corporations that are moving towards the transition?
Yes, thanks, Mireille, and thanks also to mention energy efficiency, which, apart from the work that we do with companies, I look after as a technical lead to the G20's Energy Efficiency Finance Task Group and also the European Commission's Energy Efficiency Financial Institutions Group, who were instrumental in identifying the accounting rule issue 3 or 4 years ago. What I thought I would do for you is just track back. So climate strategy has been working with companies since 2009, and I thought it would be useful for everybody to understand how companies' thinking has evolved since then, at least in the way that we have been working with them. So in 2009, typically companies were looking at the footprinting, figuring out what CO2 emissions that they were responsible for, and looking at their direct emissions and sometimes looking at the energy that was being supplied to them, scope 1s and 2. Then in 2011, we started to work with companies on scope 3, so looking down their supply chain, particularly looking at some of the more customer-facing companies, some of the companies for whom direct emissions was not the major source of their impact, but also looking at their global supply chains across the world, 2011. 2012, we began to work with companies on actual target setting, not just for their own scopes 1 and 2, but also thinking about how they might be able to influence the companies that supplied them. 2013, we started to see execution of what I call low-hanging fruit projects. So 2013 is where we began to see companies really taking an aggressive focus on, for example, energy efficiency. Whilst some heavy industrial energy users had been focusing on that for a long time, some other companies that had just begun their climate journey began to focus on energy efficiency at around 2013. 2014, own energy supply. So this is sort of becoming independent. This is the likes of IKEA who took the lead there, basically becoming, or data centers, producing their own green power. That was a 2014 sort of development. 2015, we saw the Paris COP21 drive a lot of companies who were sort of, for whom climate change was one important theme among many, accelerated their commitments. And Paris was a good thing for companies in forcing their CEOs and management boards to take a lot of decisions which I think, which may have otherwise taken a longer time. 2016, we kind of moved into, I think, whilst a number of companies had been dealing with shadow carbon prices for a while, at my firm at least, we spent some time working with a number of our clients on the implementation of shadow carbon prices, and I'll come to that because I think it's an important part of this. And then I think 2017 and now looking forwards, where we're going and what we're seeing is how do companies adopt science-based targets? For me, that's where the bar really is. Listening to our opening speeches, it's very clear that unless as a company you're aligned with the Paris Agreement and you're aligned with science, kind of what are you doing? And I think we need to sort of start asking ourselves those types of questions. Finance, of course, is a pivotal factor as we so I've been deploying finance. Anthony and I helped invest 1.5 billion euros in climate strategies prior to 2009. I think when finance, when I talk to theatres about finance, it is the decisions we make today that will affect the next 20 or 30 years. So the decisions that we make today affect that period during which we have the climate budget. So it's actually the decisions that we make today. And finance isn't, some people, I think, I've been in finance most of my career. I think some people feel that economists run financial institutions. They don't. Financial institutions are run typically by analysts, and analysts look backwards, not forwards. So most of financial institutions feel comfortable analyzing the past and then picking the market standard set of forecasts for the future. Is that a good way to make financial decisions? That's one of the questions that hopefully members of HLEG and others will be answering for us. So how do companies think about carbon pricing internally? So 1,200 companies have a plan or have a carbon price, an internal carbon price. An internal carbon price is something which is not paid as a tax or is not contributed to through an external trading system, but it's a way that a company can understand more truly the risks of its current businesses, enterprises, and the future investments. The amounts of those carbon prices can vary. The total range that we discovered was between 1 and 800 US dollars per ton of CO2. So as you can tell from that, having a carbon price and having a carbon price that is material is two different things. But what we actually focused on is the internal implementation of your carbon price, whatever it may be, is probably where the rubber hits the road for me. In other words, what do you do about the fact that you've adopted a carbon price? How do your finance teams, for example, internally use that within their models? These are key questions that we've spent time thinking about. So a project we developed for a client that we delivered together with Trucost in July of this year. Instead of, for example, just to give you a sense of whether we're talking here about one carbon price, this particular firm wanted to have 5 project types, 15 geographies, and a horizon out to 2050. So we delivered them a grid which had 2,250 carbon prices in it. And those carbon prices varied between, to give you a sense, OECD countries, which had a rough expected trajectory of 20, 100, 150, 170, 2020, 2030, 2040, 2050, emerging economies 10, 80, 130, 150, and developing economies 5, 30, 50, 70. So again, you can get from that, I'm just scratching the surface of a piece of analysis for you, but what I'm trying to illustrate is that there isn't just one number, that the number is different depending on the country that you're in, the number is different depending on the sector that you're in, and, as I illustrated earlier, depending on the project. For example, if I'm assessing the building of a highway between Mecca and Medina, then I'll want to know what the carbon pricing regime is likely to be in that geography, within that sector, with respect to the CO2 emissions, which that piece of infrastructure will both produce during its construction phase and also require during its use phase. All of these considerations are the kinds of embedding that we want to see within companies, and I think it's probably sort of clear, it's certainly clear from the fact that if I look, we just did a quick check at how many companies are employing science-based targets. The number on the website for science-based targets was just over 300. Let me just check. I will finish, yes, 326. But of the 326 companies who are committing to science-based targets, only 84 seem to have implemented it. So again, that's why I illustrate that implementation with the CLI company is the most important thing. So to resolve, I think things that you find out. So I'll close by saying the financial markets value companies based on the way that they fit into our future vision. So the reason why Tesla is one of the most valuable car companies on the planet is because people believe that Tesla fits into a future vision and investors are willing to go with that. And the reason why, for example, as Anthony will probably tell us, coal companies have lost 85% of their value over the last decade is because they don't seem to fit into investors' vision of the future. So I think that what the implementation of an internal shadow carbon price does is allows companies to create the internal demand for capital that is required to align their operations with the future vision that the rest of us have in mind. Thank you.
Okay, thanks a lot. So, Anthony, do you want to tell us about how this enlarges to institutional investors? You know, from the corporate to the bigger investment market, you're working with them at Carbon Tracker. How do you feel them moving on pushing for a more stringent carbon pricing? And just for 3 minutes, please. I'm sorry, Anthony, because we've been running completely out of time.
No, that's right. Well, and also to Peter's sort of nice segue, because they don't fit with the future, but also because demand for their product is diving dramatically because they're getting their demand models wrong, and that also applies to oil and gas. So who is Carbon Tracker? Not for profit, all former financial market professionals. The engine room of Carbon Tracker is a team of former investment bank analysts. I'm very pleased that we had the climate science presentation because, our role is to translate the science into something that makes sense on a day-to-day basis for financial market professionals. I think many of us in the climate movement or in this space over these years, I think we're beginning to wake up that our mistake has always been that we've been talking at our audience about issues we're passionate about in our own language, and we have to learn how to translate that into the language of our audience in the context of the issues they care about. And what does your average financial market professional care about on a day-to-day basis? How you balance risk and reward around any investment decision. So that's essentially what we're about. And our objective for our audience, which is the financial institutions, the asset owners and the asset managers, is to persuade them that it's in their financial interest to put the world's fossil fuel companies into a 2 degrees runoff. So, we haven't really picked a big objective or anything. So let's come to the question, carbon pricing. I actually think as a movement, we've scored a massive own goal. Because when we talk about the perfect global carbon price and implemented a carbon price, of course, the companies have suddenly woken up and gone, oh yes, well, if we talk about that and we say how wonderful it would be if governments waved a magic wand and produced a global carbon price, we're off the hook. Because we can just say, well, we want a carbon price, we think it's a good thing, we'll do it when the governments act. We're off the hook. Massive own goal. We have to get away from that, and we actually have to start putting the obligation back on the companies. In the run-up to Paris, the CEOs of 11 of the world's biggest oil and gas companies made a statement about carbon pricing. What has our movement done to hold them to account since they made that statement? How have we said every year, well, you made that statement last year. What have you done in the last 12 months about that? Are you paying a carbon price? How does your, to Peter's point, shadow carbon price work? Well, actually, that's a bit pathetic, isn't it? The way you've structured your internal carbon, that's not a real carbon price. You're persuading the world you have this internal carbon price, but it's all smoke and mirrors. You're not actually, there's no economic pain or movement associated with that internal carbon price, is there? And it's actually only on your tier 1 emissions. You're not actually putting that on your product, which is the biggest part of your impact in the world. How are we holding those companies to account? We have to, because governments are not going to act to impose the carbon price we need anytime soon. So I think that's critical. The other, which is not relevant to this discussion, the other thing they hide behind is carbon capture and storage, CCS, which in our view is a fairy tale and avoids a discussion about where we really could get those negative emissions. But anyway, that's a whole different topic. So I think that's really important. But actually, there's some good news and bad news. I mean, the analysis we're producing and the analysis of others shows actually we're in that transition. We are now in a technology-driven, low-carbon transition. Our recent US coal report showed that 78% of US coal-fired generation now is having to be subsidized by US ratepayers to compete with cleaner alternatives, to the tune of about $10 billion a year. So US energy users are paying an extra $10 billion a year to keep that coal going and to make sure it's competitive with cleaner alternatives. For some of them, that's 10% of their energy bills. We're about to publish our European coal report on Friday, and the result, the financials of coal are in Europe are in a similar state. It's no wonder we're starting to see more and more calls to subsidize coal and for coal to get subsidies, because actually coal does not make financial sense anymore for a whole suite of reasons. And actually, if we move to oil and gas, many of oil and gas's projects that are in the pipeline do not make financial sense anymore. In our recent 2 degrees of separation report, we showed that 2.3 trillion of the planned exploration and development is not consistent with 2 degrees, and actually probably doesn't make financial sense. In our sense and sensitivity report, we showed that if you put some of the biggest oil and gas companies into a 2 degrees runoff, they're actually worth more. Their share price would go up. Their financial business or their business model will be in a stronger condition. They'd be better able to pay dividends to the shareholders and pension funds, which is a key consideration. So we are in this paradigm shift. And actually, we need to get better at talking about that, not burden and effort, and you've got to step up, we've got to work harder to get that boulder up the hill. Who wants to push a boulder up a hill? You're not going to get anywhere trying to persuade people to do something that's painful and difficult. But if you say you can roll that snowball down the hill, it's going to pick up, it's going to get bigger, it's going to grow your economy, it's going to create jobs, it's going to be a better investment, you're going to make more money out of that. And if you continue in a business as usual pathway, you're going to create financial risk and you're going to lose money and you're going to create stranded assets. That's the language we now need to be talking. And there is the financial evidence there to show this. So this is the language we now need to be adopting as we push to step up ambition towards 2 degrees and beyond. So, and again, picking up on one of Peter's points, the problem is much of the way we look at risk and we look at these issues to date has been backward looking, which is why the work of the Financial Stability Board, the G20's Financial Stability Board, and the Task Force on Climate-Related Financial Disclosure is so important, because that's moving us to developing forward-looking indicators. And it's critical that we get objective scenarios for 2 degrees, 450, 1.5 degrees, against which we can stress test, or against which the companies must stress test their business models when they make disclosures. So that is absolutely critical. Now, my view is then, and we also then need to make the case to the financial markets as to why a carbon price is important. So why is a carbon price important to the financial markets? Because actually in this transition, in this changing world, a carbon price will help manage financial risk. It will help move you away from those investments that will create stranded assets and lose you money towards the investments which will be better financially, will give you a better return. It will help avoid value destruction and drive you towards value creation. And it avoids stranded assets. And the final point, why would governments want a carbon price? You know, why is it in their financial interest? Because if we're right about the future direction, so in our, which report was it? Our Expect the Unexpected report, where we looked at the disruptive power of technology, electric vehicles, solar, wind, etc., on demand for oil, gas and coal, we found that when you really update those demand models and you move away from a sort of linear approach, you know, we are likely to see much more aggressive growth in electric vehicles, wind, storage, energy efficiency than we have seen to date, which means we will see peak demand and then a rapid decline for coal by 2020, peak demand and probably a decade-long plateau before it declines for oil, and much less aggressive growth for gas than the industry sees. Well, what does that mean for treasuries around the world? You know, a big part of their take is taxes on fossil fuels. So it means stranded budgets for governments. So where should governments look to replace those stranded budgets? Well, carbon pricing is an obvious choice, particularly if they believe this tail-off is just inevitable. It is going to happen anyway. Thank you.
Thank you very much, Anthony. So we are going to close this panel. I'm very happy because I think that you have convinced us, or at least me, but perhaps I was already convinced, that that for NGOs, you know, coming back to Finance Watch and what most of the people in this room are doing, it's a very good advocacy cause to try and hold our governments and also corporates accountable for doing the maximum to trigger this transition. And carbon price is something which is not yet at all at the right level. We can do more. We should do it. I think everybody on the panel agreed. Thank you very much. And now we're going for 20 minutes of break, I think. Thank you.